Buenos dias, everybody. It's Friday. We nearly made it to the weekend. Going to be there soon enough. Fun and games in yen today. Who'd have thunk it? We'll get through all that, but some big old moves happening this morning. Probably we need to be a bit careful of, but we'll get over that. I'll give you my thoughts of that shortly. Let's get stuck right into it. China's FX regulator says that supply and demand in FX markets in the first half of the year were basically balanced. So not seeing too much of these recent moves in dollar China. Says the Fed tightening is coming to an end and thus the spillover effect is weakening. China lending rate may drop further in Q3 if the PBOC cuts the RRR, according to people talking to the Shanghai Security News. Pretty much economists giving their view on that. We're going to come over to Japan, and everything's been happening in sort of stages. So obviously last night we had the CPI data, which came in on one of the core numbers as expected, 3.3% versus 3.2 prior. The main CPI number came in a little lower than expected though, 3.3% versus 3.5 expected. So only a pip up on the month before. There is another measure that's not on this calendar. That's the fresh food and energy, the core. That also came in as expected at 4.2% and down a pip from the prior 4.3%. So bit of a messy picture, but overall inflation has risen, whichever measure you look at, or is staying particularly sticky and well above the Bank of Japan's target. Now, what we've seen is since then that there's been a poll out from Reuters and a lot more easing of tweak hopes for next week. According to economists polled by Reuters, 77% of them say that they will not start unwinding their ultra easy monetary policy in July. Only 5 of the 22 economists polled, that's about 23%, said they expect the BOJ to start scaling back or tweak next week. That's down from 43% who thought they might tweak next week in the last poll in June. Now, speaking about when the Bank of Japan might roll back policy, half of them, 11, anticipate that they will do so by year end. The other half say they won't, so a bit on the fence on that one. But they were asked a separate question on when the BOJ will end YCC, and the answers were a bit spread out, shall we say. 3 of the 22 said they will start later this year. 5 said it'll be in the first half of next year. 6 said the latter half of next year, and 8 said 2025 or later. So so-called experts are pretty split on when they think they will pull things back. Right, so then we got this morning, as you can see from the chart there, and that funky move, which really was a real rocket. We got a good old Reuters sources piece saying that the BOJ sees little need to act on the yield curve control for now, saying that they're still not confident about hitting their price goal stably. They view keeping easing as important amid the progress. Still likely to discuss a YCC change even if there's no tweak. And they continue to see smoothness in the yield curve and no major issues in bond market functionality. So that all sounds a lot like slamming the door on any action next week. However, much like UEDA earlier this week, saying that they would only look to change policy if their assumptions changed, one of the lines in this piece says that they will reach a final decision after viewing the latest data. So the latest data is higher inflation, still above target. This has been running now for a year. of seeing higher inflation. So it does leave the door slightly ajar to them doing something next week, whether that's tweaking or language change or whatever, because they're waiting on all the data before making that decision. And as the line says, they're still likely to discuss a YCC change, even if they don't tweak it. So that leaves the door open for some language on them potentially tweaking. Now, how does that leave us now? Well, firstly, I wanted to say that, you know, we were watching this move from the 145s. A hell of a lot of it was down to expectations for the Bank of Japan changing something, and now you see what happens when those expectations get stamped all over. You get these types of moves where the market finds itself, enough's enough, they've repriced enough. Now we get some headlines and stuff that says, hang on a minute, you're wrong, and we get a big reaction back up. This reaction here, I think, is a hell of a lot. 170 pips, 160 pips, that sort of thing, I think is a big old reaction. But you know, it's undoing a lot of a big reaction that we first saw coming down. So no real surprise to see it up here. I think we potentially find a bit of a balance now, because all those who were selling here, part of the reason we got this big jump this morning is a lot of those shorts are probably chucking in the towel. You know, if they weren't taking profit down here, they need to be taking profit around here. So it adds to the buying frenzy. So it creates a bit of damage against them. Self-fulfilling prophecy, if you like. I think from here we find a bit of a balance. Now, for the BOJ, they're in a bit of a situation, and we need to know how the land lies from here. Okay, now there's probably three main scenarios. They do nothing. They keep everything unchanged, including language, including forecasts. Okay, if they do that, this thing is heading probably to 150, let alone back to 145, if there's a complete unchanged scenario across everything at next week's meeting. However, if they don't tweak, don't change language for a tweak, but up their inflation forecasts, and those inflation forecasts go above 2%, that's going to get the market trying to price a later tweak, maybe as October, as some have mentioned already. So that would be a bit of a hawkish tilt anyway. Now, what they could do is up their forecasts and do a little tweak, get it out the way, give themselves some room. That would probably be the most hawkish scenario. And then we're likely to see yen strengthening quite a bit. And, you know, we're probably going to be down back at 138, if not worse. So those are the three main scenarios I'm looking for now. I think one is unlikely. I think two is probably the strongest possibility, i.e. they don't tweak, but they up their inflation forecasts, maybe language on a future tweet, and the market interprets that as there's a tweet to come. Or three, they up forecasts, up their language, and actually tweak. So I think number two is where we're sitting at the moment. That in itself would be bullish for the yen, but I just, on the balance of things sitting here now, I can't see them coming out of this meeting without the market seeing it as a hawkish shift, be it small or large. So that's where I think we are for now. So I think going into the meeting, I think yen strength is probably the most likely outcome from this. But obviously we have to take the Fed into consideration, everything goes on there. But what it might do is give us an opportunity, okay? If the Fed are in any way unhawkish or dovish, then obviously dollar yen is going to fall. Then, you know, going into the Bank of Japan where your risk lies, that means we could get a further fall or it goes down. Now, if the Fed are hawkish and keep their language pretty strong and we see the dollar rise, that's dollar yen going up, then I think that may be an opportunity to look at shorts into the Bank of Japan. Because as I say, I don't think they come out of this with any sort of dovishness at the end of this meeting. So that's the sort of opportunity I'm looking at right now. Obviously, the price action will have to conform and other events will have to conform as well. We've got US data, we've got whatever happens on the US side till then. So lots can happen, but that's my early thoughts for next week's BOJ as to how to play it. Right, moving on, we'll come back and look at the prices and this in a bit more detail shortly. In the UK, Sunak lost 2 out of 3 seats last night in the by-elections, which sort of can be considered a bit of a political win, as it could have been far worse. But also that the voting showed that the opposition party Labour may not be quite the shoo-in for an election victory. So I think we could probably well be heading for political impasse at the general election. Now, there's rumours that the date or the month for that election is going to be November next year. So that might need to be penciled in our calendars because we're going to get a lot of electioneering next week. But as far as the pound goes for the election, last night, no real moves over it. Nothing much going on there. As I say, it was a bit of it could have been worse, let's put it that way. He lost 2-1 instead of losing 3-0. But anyway, we should move on from that. Now, what did give the pound a bit of a kicker this morning was retail sales. As you can see there, it hasn't lasted. Retail sales came in better than expected. Let's get the data up for you. There we go. So retail sales coming in 0.7% versus 0.2% expected, and better than the 0.1% prior as well. Year-on-year sales not as bad as expected, only down 1% versus minus 1.5%. Core sales, so stripping out things like fuel and whatnot, came in also positive, decently at 0.8%, and not as bad on the year. I'm not sure why these expectations were set so low. We did have the coronation and all sorts of the additional bank holidays. And as I've been mentioning a few weeks ago, things have been pretty busy here in the UK when you go out and look around. Plenty of people about, plenty of people spending. May not be buying big ticket items, but still going out and still enjoying themselves. Bars are still busy, restaurants are still busy. And everyone had a little spend up over the coronation. So I'm really, again, surprised that these numbers were quite so low. Over to Turkey, and they hiked by 250 basis points to 17.5%. A lot of the market were looking again for them to hike to 20% as per the previous meeting, but no, they went a bit less. Still expect to keep hiking is the message from those guys over there. All right, coming into the US and look at the data yesterday, and a bit of a mixed bag, perhaps, in some aspects. Jobless claims looking very solid, 228K versus 242 expected. So down at the lower end of the recent sort of ranges we've been seeing in these numbers. 4-week average, a big improvement there. Continued claims, though, did have a little bit of a tick up. Usually all moves the same way together, but they ticked up a bit there. Then we got the Philly Fed manufacturing, which was worse on the headline number, but better in some of the other components. Employment was still a negative, but not as bad. New orders were worse. Prices paid pulled back a little bit. But what was very strong was the conditions for the next 6 months. So expectations for the next 6 months coming in a healthy 29.1. CapEx as well, showing a little bit of an improvement over expected, but not as much as last month. But that 6-month expectation strong number tends to think that many are seeing things a bit softer now, but they expect conditions to improve. It's an important number because if you think something's going to go get better, you set your business up to take advantage of that. So on the whole, I would say this data, purely because of that number there, was a bit positive. And the market took it as thus as well. Just after that, we got existing home sales, which were a little bit off, but nothing to write home about, nothing to worry about. And good old Eurozone consumer confidence coming in less crappy at minus 15.1. Maybe in your lifetimes, you'll be lucky to witness a time when it turns positive. Don't hold your breath. So after all that data, as I say, a bit of an improvement in sentiment, particularly for the Fed. Fed swaps marginally priced the odds of a hike after July higher. It wasn't a big move up in expectations, but nevertheless, it was a shift in that direction. We've been doing a lot of unpricing of the second hike for the Fed, but those came back in a little bit. Just a couple of earnings, just to show you that things are still coming out rosy in that front. American Airlines, their Q2 beat. Philip Morris, one of the big tobaccos, they also beat on expectations. So now we're just starting to get some of the other sectors dropping down as well. We obviously had the banks and financials this week. We're just getting some of the other sector companies dropping as well. And by and large, everything is hunky-dory as far as those go. So no worries at the moment in terms of activity in the US. Keeps the soft landing narrative in play. Nothing much else going on. China and Russia doing drills in around the area, Black Sea and whatnot. Russia stimulating or simulating rather, pulling up ships in the Black Sea and seizing ships. Part of this rhetoric over the grain deal, where now if they see ships sailing around the area, they're going to consider them as unfriendly and possible targets. So China and Russia playing with their toys in the bathwater, and that's continuing on for that. Right, so let's get stuck into what we've got coming up today and having a look at markets. Data front is very quiet for the rest of the day. I don't think even think we've got any US data coming out. No, all we got is Canadian retail sales coming in later, and some manufacturing sales and the house price index. So any loony traders, keep an eye on those numbers there. Right, so back to good old dollar yen, and I've got a bit of the hump. I had the hump this morning because I did take a break trade in the 140s, 140.03. I got in yesterday just to test this break, and overnight I got stopped out before the CPI data, and then my PC was knackered this morning, so I've been spent all morning trying to fix that, and it's the PC that runs A, my Reuters, and B, my trading platform. So the first time I heard this news from the Bank of Japan, it was on the squawk, and by the time I got my phone open to do something, it was already trading 140.80s, 140.90s. So not only did I get stopped out on my long already from 140s, I then missed grabbing the whole of that move there. So trading is hard enough, as you all know, and so when you have missed opportunities like this, it tends to give you the ump a bit. But I'm over it now. I've got no one to blame but myself. I set my rules and my stops for this trade. Couldn't do anything about it when I'm tucked up in bed, so can't really have a complaint about that. And shit happens, such as computers going tits up at inopportune moments. However, I'm not going to complain too much because I'm still long from 137.95, so I've been chopping that in this move up here, and it's been a big strong move. I think we're going to run into trouble. Well, we already are running into trouble up into 142. I mentioned in our chat room, I don't like short-term fibs. I've put this on the chart just because, you know, if markets are quiet, it may, you know, do something. As you can see, it didn't do much at the 50 fib, carved straight through. The 61.8 is a natural old support point when we came down from 145. So it warrants keeping a close eye on. We've got another level just above 142.25. Again, another old support and resistance area, so worth putting in the mix. We carved through it on the way down, and then you know, it was one-way traffic from there on in. Now, as far as support goes, and I'm used in the chat room that, you know, when you get a big move like this and it carves up through a few levels, sometimes you just need to sit back, let the market do its thing, let it show you where the levels or the support levels in this case are going to show up. Now, I did muse that 141, 30, 40 might be somewhere that happens, and lo and behold, 141, 40 is where that's happened. From here, I think we're going to find, as I said, a bit of balance now over all these expectations. We had the boat rocking one way here. We've had the boat rocking the other way here. It's rocked a bit extreme here. So, you know, I think we're going to settle down a bit now. I would be surprised if we went through 142 today, but maybe the Yanks coming in shortly and they'll read the news and they'll give it another leg up. So if we do break 142, that's likely going to be the reason. If that happens, again, we might get a bit of an acceleration. If there's more shorts with stops around here, they're going to add a bit more as well. Maybe we get up to 143. But even if that happens, I still think, you know, we're going to start to find things a bit stickier in terms of the upside. Purely, as I say, because we're going to be more balanced on these expectations now going into the BOJ. What has also been funny, what happened there? What has also been funny is that now we've had this move. The old FX diplomat Kanda has been out saying that excessive moves are not what they're looking for in markets. Well, stop dropping poxy sources stories in then, and you won't get any FX volatility, my old mate. So, you know, that gave us a good laugh in the chat room. Mike, do I expect Japanese MOF officials come Monday to jawbone dollar yen down? No, I don't. If we see this carrying on, if we do get another, you know, 100 pips tacked on top, then we are in the realm of excessive volatility. But you have to look at the picture as a whole. You know, you could say they were getting a bit vociferous when we were bouncing, you know, back up to 145. They were all starting to jawbone here. We've had a big move down, which is in their favor. You know, they've got to expect, they will be expecting the headlines to bring a bit of volatility. But we're not back up at 145. We're not spent, you know, the best part of 2 months tacking on 1,500 pips. This, in the grand scheme of things, is just a bit of market moving around. It's not the market getting overly speculative. You've got speculative here. You've got unspeculative here. It's more balanced here. They'll understand that. So we're not in speculation range. I don't expect to hear any real jawboning comments unless we're, you know, shooting back up to 145 pretty quickly. And then those same comments will be coming out. But they'll also probably have half an idea what the Bank of Japan are up to anyway. So they know if the Bank of Japan are going to announce something that's going to be volatile for markets, they know that that's just market moves rather than speculation. So they'll let that slide. But I think what happens after the Bank of Japan is going to be important. If they leave everything unchanged, as I say, completely unchanged, we're probably going to take out 145 pretty quickly. That'll bring them back into jawboning very strongly. But in the meanwhile, yeah, I think we're probably going to find a bit of balance now, maybe a bit of sideways action. Still might need to see where the real support points coming in. We've had one tagged, 141.40s. Let's see if that becomes something bigger. If not, maybe we have a move down to 141. For me and my longs, I think I'm going to start yanking up my stops pretty significantly now for my call it 138 trade. I'm going to start yanking that up now, making sure I protect what I've got and taking advantage of any opportunities if the price moves higher. So that's my thoughts for dollar yen, and obviously we'll see what happens next week. We've got the Fed as well, so you know this could be volatile just on what the Fed does, and the MOF and the jawboners, you know, they can't step in and jawbone it when it's the dollar side that's doing the moving. So always have to take the currency on both sides. Right, looking around, we'll jump back to cable again. Yesterday, looking like we may have stopped falling. You know, this morning we've tacked that low. Well, firstly, we got through 129 again, made a new low. So that keeps the trend going. We've now held that low this morning, so you bottom pickers, it got a bit of evidence to say that maybe we're halting the slide for now. You'll need to be very careful. Watch the bounces. The bounces aren't looking too hot at the moment. 129, give or take, is now resistance. So be wary if we continue to make lower lows. It keeps this pressure on, this bearish pressure on. We've messed around with this 128.50 area. We've had a little break under. So 128.50 itself is not really a level anymore, but we're not closing below it or holding below it for any significant amount of time. So that's potentially important. I've still got the fib down here at 128.24, may still be a consideration. But if we're not holding 128, we're not that far off. You know, it's only 26 pips away. So a proper break of 128.50 might take this level out, this fib out without much fuss. So bit of the jury's out this morning. Keep an eye on that. Watch the bounces. If we can't get through 129, keeps the downside pressure off, means we're likely to make new lows after that. Conversely, we need to get back above 129 and hold it to suggest that we're done dropping. Euro sterling also easing off a bit as well. Bit in part to what euro dollar's doing. Euro dollar's looking a bit weaker as well, but we've had a couple of attempts up here at the 87s. Can't get through. We're now messing around with this zone. It's becoming a bit wishy-washy. We've had a move under it. Bit of a bounce, but the bounce hasn't lasted. So the market is a bit unsure what it wants to do here. So the main level for me down here, probably going to see some action around 86.20, but for me it's 86.10 down to the big figure 86 is going to be the main number here. If we come down here, hold a bounce here, I may look to add back into some of my longs that I've been holding from down at the 85s. And we'll see what happens. Obviously, the ECB next week in the mix as well. So I wouldn't be surprised if a lot of this perhaps is a bit of profit taking in this pair, just with the ECB risk next week, because for this pair, it's done quite a bit in quite a short space of time. Doesn't often do that. So won't be surprised if a bit of this is profit taking. Euro dollar looking a bit similar to cable now. It was holding up a bit better. Cable went first. Now the euro's gone as well. Bit more on the dollar side, this one, rather than what's going on in the eurozone. Although those expectations for the ECB have been coming down alongside all the other central banks. Support, it's been a bit of a messy picture for me, picking the levels out of this one. It's really been about the big figures in the main. We have got this trend line that we're mucking around on, but it's not looking anything decisive. Let me just double check which trend line that one is. So that's a bit more of the short-term trend line, as you can see, just coming off the moves this year. Let's get that a bit clearer. So this is just basically back to February, just marking these along these tops here. So we're mucking around here, but it doesn't look decisive that we're going to hold it nor break it, as you can see there, just mooching around the level. So 111 for me is probably the main number here. It didn't do an awful lot on the way up, but you know, that was a big strong move that we had on the way up. But as you can see, back in April through May into May, you know, we found it a bit of a sticky point. So it may not have done too much on the way up, but sometimes old levels can show up on the way down, on the opposing move, shall we say. So 111 is probably your bit of the line in the sand for this whole move here. If we manage to hold that, then it keeps the top side in play. Whether we can get back there is another question, but it means we are potentially not going to unwind all of this move just yet. So that's my key level moving forward. 111, call it 110.90 as well, because sometimes it likes to have a little mooch under and suck everyone in and then spit everyone out. Aussie dollar still looking a bit weakish. Haven't quite yet got down to this 67.40. Close enough, 5 pips away, 6 pips away. having a little bounce now. Again, it's all about whether these bounces are actually worth anything. As you can see, we're in a bit of a downtrend, just making a new low after the days of finding a low, bouncing, making a new low, highs getting lower. So, you know, this, to me, that suggests we're probably going to have a test of 67. That's where the big question needs to be asked from that point on. Ali, Ali's up. So you got your short yesterday in euro dollar, so very nice with that one, and you're in again today. Tell me, did you get out all your trade at your profit point yesterday, or did you keep some on the board and run this break further down past where you wanted to get out of? Because it's something I was thinking about your trade yesterday, and I mentioned towards the end of the show, you know, think about taking not all the position off, leave a little bit on, give yourself something to play with and see if you get the break through your level, which you would have done. We're talking euro dollar, of course, because I think you were 111.95 was your TP, because you were emotional. Okay, well, maybe have a look at trying to do this time, and maybe some of the other boys and girls can try that with your trading. If you've got a set profit target, I'm never going to tell you not to take profit, and I'm not telling you to change your strategy and do exactly what I'm telling you to do, because that would be financial advice, which I'm not allowed to give. But what I am is making a suggestion, if you can do it, is, you know, if you can cut your trade, even if it's 90%, and you leave yourself a little bit of money on the table, an insignificant amount, that if you get stopped out, it's not going to upset your original plan. Just try to do that. Leave a little bit on the table. So if you get your profit target hit, see if it goes a bit further. And if you get some confidence in doing that, you know, as my theory always says, I don't like to give up a winning trade, then you can really help maximize your profits. But it's fine what you're doing, Ali. I'm not trying to change your strategy or anything like that. I'm just trying to help all of you with an opportunity to try and increase those profits as much as possible. You know, it's fine trading it in small bits on your levels, making money, absolutely fine and dandy. But there are ways you can try and increase your profits and just squeeze out as much as you can from a trade without doing yourself any damage. If you've taken profit in the first place on a lower position, it's a free trade. So, you know, just give yourself that opportunity to make a bit more, some icing on the cake, as you call it. So yeah, let me know if you do have a go at trying that. Let me know how you get on. See if it works for you, because that's something you can always build into your strategy. If it doesn't work for you, fine. You've had a go. You know, you're unlikely to lose any money if you've already taken a chunk of profit. Just see how it goes. And as Gavin says, you know, maybe journal your results. See how it goes. Watch the price action. When did it work? When didn't it work? What was the reason why this time it worked? Another time it didn't work. And then you get to, this is your experience. You know, people look at me and K-Man and Blake and Stelios and Steve and Dale and all these sorts of people who are so-called experts. Okay, we're only experts because we spent enough time gaining all this experience. So all these things you're doing now, everything trade you do, every time you look at the market, press a button or whatever, you are gaining the experience. Okay, and it all builds up into your mental bank, and you need to learn it, so then you know certain situations, you recognize them. This pattern is something I've traded before. Usually this happens with this pattern, and then you trade that way, and that's how you stay in the game. That's how you maximize your profits, because you get to learn, you get to gain the experience to look at markets, look at price action, read it, see how things develop. You know, this is how I saw that this move under 138 was a bit of an excessive move. You know, it was overkill. What told me it was overkill? Well, we bounced pretty strongly from it, and then we found the big level support straight after. You know, this is experience you should be learning. This is experience that when you next see a similar situation, you go, oh, that's a big move. We've hit a big level. Oh, it's had a little blowout at the big level, but boom, it's bounced strongly. I remember that from when we were talking about that in dollar yen 6 weeks ago. Now I know how to react to it. Now I know the signals to look for, so I can capture a move that goes all the way up, another 400 pips. It's all experience. This is what we're trying to do with these shows, not just to say, hey, look how good I am, I guessed this right. It's to say, learn what I'm learning, learn what I've learned, and then you can make the money on moves like this. Anyway, enough preaching. It's a Friday. It's time for beer drinking, not preaching. Right, anyone else got anything you want to talk about? Come on, guys and girls. Gavin, Donna Rand. Yeah, certainly is putting up a bit of a fight down here. Again, you know, price action, you get lows, you get new lows, you get another low. Now we get a higher low. So it has the potential to be forming a bit of a bottom down here in dollar rand. It may be indicating that it might be stopping falling. You need to see how the price progresses from here. If we start to see this happening, this will be different to what's been happening previously. So now you've gave yourself the price action you can view. If we come bounce up to here, come back down to this line, which will be higher than this low, then you can get a bit of greater conviction that this move is over. I don't know what's going on in the rand at the moment. I know that they're going to continue with their monetary policy likely. It's all a bit of a mess. I don't need to know what's going on in South Africa to trade the price action going on here. All I do is look at the clues, let the price action tell me what it wants to do. So it is making a bit of a potential bottom down here. So you've got a line in the sand down around 1780, call it, and a final line in the sand down against this low. But if you come down here, test this low and it holds, again, gives you some conviction that A, this move is a bit of an excessive move, and that maybe you have got more of a solid bottom in play, and it can continue higher. Now this has had a big, excuse me, this has had a big move already. Looking at something like a daily. So in the wider picture, we're still well within the trend, even with this pullback. Let's get rid of this old crap there. You can see the last time I teched up this one, but if we take that, not even close to the 38.2 yet. So you've got two different contexts going on here. You've got the longer, wider term context going on from June last year. The trend is definitely still in play. Then you've got the shorter term context where you've had a move off the top and the trend short term is coming down. So where those two lines meet is where you can often get a good trade. You know, we've got this level down here, 1770, just below the low we've already made. So a move down there in the longer term is where you're looking at for potential support. You could call this a hold of that support already. So then that makes things look a bit more bullish. So when you compare it to what's happening in the moment, in the short term, you know, you can see that price action playing out. That for now, we've stopped going down. Was it because of this support point? Maybe, but what are you going to do with it after here? What does it need to do to really turn around this short-term trend? It needs to get back above 1820 in the first instance, you know, and then that's how you do it. That's how you trade it, folks. Just let the price action do the talking. Dollar CAD, Gordon. Let's have a look at good old Looney. So those retail sales, not huge data, but it's the only data we've got. We've obviously got the Bank of Canada a little bit, or the market a little bit on the fence over whether they pause or hike at the next meeting. So this could be decent data to watch for nothing else going on. Give us some moves. Again, similar situation that we're looking at in a lot of pairs, trying to pick bottoms. Oh, missed it. So here we have another one showing signs of potentially bottoming out, hitting a low, bouncing, coming back down, breaking a little bit, straight after, we're holding the level again. So you know where your risk is. If you want to take a trade, you take a trade down here, 131.20s, maybe even into 131s, or you have your stop down under here somewhere and you go long here. Because this is your level, this is your risk level, this is where you manage risk. we come down here, yeah, you might be worth trying along. What you want to be worried about is the fact that the bounce this time is very weak. The bounce this time is weaker. So potentially it's a bit 50-50 whether we make a fresh low and break this low, given how the price action is still edging down. But you want to trade somewhere. So you can trade here with a tight stop, you know, 131.20, call it. You don't need to stop more than, you know, 130.90. So maybe 30 pips on this one, given the levels you got around here. Maybe if you want to push the boat out, reduce your size, go below my 130.80, something like that. So if you want to catch the knife, know what the price action's doing here. If we do get a bounce, well, it needs to get back above 132, as mentioned earlier, or the other day in this one. 132, 132.20, 25 is really your level. Need to get above there. Get above there, then you've got every chance of pushing higher. So if you're going to trade off of here, you need to be asking a question what you do with any profits when you get to the back up to 132 if it gets there. Maybe take half off the table, bring your stops up, your trade's in profit, your stop's locked in, you cannot lose. Then you can let the trade do what it wants to do. And if it breaks up, fine, then you go with it and you're making your money. If it doesn't, if it comes down and knocks out your stop, okay, well, you made a little bit on half the trade. Fine, that's still a plus, that's still profit, it still goes in the bank, it still pays for your weekend or whatever. Yeah, Brand, you only have control of your risk. Gavin, EuroCAD. Yeah, I've not really kept a close eye on this one since we had the break up. Oh, look at that, we're back at it. Oh, well spotted, sir. So everything going on, I took my eye off this one. Typical, decent technical price action. Had the break, held a support. We've had a little run up, found a bit of a top up here, couldn't get through, although we did nick a high after the first high. But it's faltered since then, and then it's pulled back through, stepping down, stepping down, stepping down, bang on the level. Question to be asked now. We had one test of the level, pretty weak bounce. Now we're back here again. So for me, that tells me the price action says this level might be in a bit of trouble. If you want to try along off this level, you don't need to give it a lot of room. 10, 20 pips maybe at most. Because if we break under here, then likely this move is all over. So we were talking yesterday about, you know, risk reward. So you can risk 20 pips, 25 pips on trying along here, you know, because a bounce, if you clear this high, is going to be 25, 30 pips. So it's a bit of a, you know, one-on-one ratio risk reward. But if we do hold this a second time, you're more likely to get a better bounce up. So you make your money if that happens. But keeping low risk. But thanks, Gavin, for spotting that one out. As I took my eye off the ball for that one. Are you looking at this one to take a trade, Gavin? Or are you just keeping your eye on the price action? Yeah, don't like the speed of the move back to here. Yeah, that, again, is something you need to learn, how quickly we come back to a level and the price action that's behind it. You know, this looks pretty similar to dollar yen off 145. You know, all right, it's over a much shorter time frame, but you break down, weak bounce, break down, weak bounce, break down, weak bounce. You know, again, two contrasting trends. This one here in the longer trend, this one here on the shorter trend. If you find a decent point where both those trends meet and ask a question, then that's when you get a reaction. And the 146, 45, 50 is exactly one of those levels. That's why it's a big fat red one on my chart and goes back donkey's years. Ali, why everybody in market says some very expert traders lose 40% of the trade and get 60% profit, so they make 20% money. I think I get what you're asking. Why do they make more money on the smaller percentage wins? I think is what you're trying to say. It might surprise you to learn. Okay, and I checked this out once because someone was talking about it. It was actually the Traders Summit last year, or maybe the one before. I think it was Mark Minervini was talking about it. and he was talking about he's only got something like a 52% win rate, which seems pretty low, doesn't it? But it's what you do with that win rate. If you can make more on your win rate than you lose on your lose rate, you're going to make money overall. And so I actually checked it out myself, and I only had at that point, I thought it was much higher because obviously I make money. It was only a 51% win rate as well. And the reason is because I maximize the winners and minimize the losers. So if only even 50-50, if you've got a 50-50 win-lose rate, if you're making 100 pips on each winning trade and only losing 50 pips on the losing trade, well, you're in profit all the way. You're not losing money. You're making money. You're making good money. So this is what goes back to what I was saying earlier about trying to maximize your profits, you know, trying to squeeze every pip you can out of a winning trade, because then that tips the balance between a bigger profit on your wins and smaller losses on your losers. That's the ratio you want to keep in a positive. You want to keep your winning trades higher than your losing trades. You do that, you're guaranteed to make money. So you can even have, a 49-51 win-loss rate. But if you're making more money in that 49% than you're losing on the 50, you're making money. So, you don't need a 90% win rate. No one should even think they should get close to getting a 90% win rate. All you've got to do is make more in the winners than you lose in the losers. And if you get that ratio right, then you're an easy street. You're sailing, and then you just work to reduce those losses, the amount of losing trades even more. It's okay losing less money. Now work on losing less trades. You improve that ratio while keeping the winning ratio. Well, then you're making very good money. So yeah, it's the thing with trying to work out things like that is that it can paint an unreal picture. You think, oh, I only win 51% of my trades. Well, if you're making double the money on the winners, that's good money. So you can't. It's like the risk reward ratio. It can paint a false picture, and you can't read too much into it. You use it as a guideline. You use it to base how you're making money. You factor that in to your win-loss ratio. And you can work it out from there, and just helps you. Those sort of things just help you keep an eye on your performance and tell you where you need to improve on things. If we make more winners, we need to take more risk. No, you don't. You don't need to take more risk. You don't need to take more risk. That's exactly what I was explaining to you before, and for the last 2 days about pushing your trades. If I get in a trade and I take half my money off when it goes my way, after 20 pips, and if I've had a 20 pip stop, I bring my stop up to minus 10 pips or minus 5 pips, I'm guaranteed to make money. Okay. Now, if I get out my trade there and then, I can't make any more money. I've made what I've made. That's it. Done. Move on. But the reason I'll take half off or some of the position off is because if the trade keeps going my way, that's where I maximize my profits. I'm not risking anymore. I mean, in fact, I'm risking even less because I've cut some trade and I've pulled my stop up. So my risk is already down. And now I can let the winning side take care of itself and push that side. Okay, so you've got it now, Ali. Good stuff. Good stuff. You've got to push those winners. I can't stress it enough. But no, you don't need to take more risk on it. Good. I should write this all down, or you should write this all down, Ali. Stick it on a notepad and reflect back on it. Right, let's have a quick look around. I've not got too much interest in much else. Oil's been edging back higher again. I don't know if this is a bit geopolitical or what's going on with producers and whatnot, but certainly it's not going down. And I was thinking about trying along if we got down here, but doesn't look like we're getting back down to this zone anytime soon. So price action says that we may be getting a little bit of a move higher. We'll see if it breaks this prior high here up in the 77s. If we do, we're probably on for a run to 80. I'm not too interested in getting stuck in around these sort of levels. What I will look to do is maybe play the range, the bigger range, if we get up near the top, and that's up around 82.50, which, as you can see, old fib level, but it's also been a bit of a decent support and resistance point. Bit of history behind it, plenty of months behind it. So, you know, we've had a little mooch around here. Maybe we're going to have a look at the top end of this range. So that's about the only place I'll potentially try a trade on this one. As I said, I'm not going to chase it up here. I didn't get down to an area I was comfortable buying at it or buying it. So I'll wait and see if we get a move up here. Maybe try the top side. Again, won't be a big trade. I won't give it much room. 82.50, I'll probably have a stop just above 83. Above that high there, 83.5. So maybe sort of 83.70, something like that, if I do have a go. No need to put the farm in it. If the range holds, then maybe it stays within the box and we have a move back down. That's how I look to make my money. Play the edges of the range. If they hold, then they can give you a decent move and you can make plenty of pips on that one. Right, anyone got any other questions? Mike says, look at your P&L monthly to get a better idea about how you're doing, not just daily. Yeah, you know, the good thing about technology these days and a lot of platforms is they do give you a lot of analysis on trade performance and whatnot. It's always worth monitoring, keeping an eye on, but don't become a slave to it. You know, don't just look at your numbers and think, oh, you know, I need to maintain those numbers, or, you know, we always need to improve. But yeah, just don't become a slave to it. If you're making money, that's all you want to do. Doesn't matter if you're making small money or big money. You can always improve. It's all about making sure, first and foremost, you're not losing money. If you're not losing money, the rest should take care of itself. Anyway, enough lessons. Right, I'm going to call that a day, folks, because it's been a very tough week, a bit knackered. I'm going to be finishing early because the kids pack up from school. They get a half day today, so going to take them out and treat the kids to an ice cream, one between them, because my Dolly Yen 140 trade got stopped out last night. If I was still in that, I could have bought them an ice cream each, my two sons. So I'm going to, one ice cream, 2 spoons for those two guys. Anyway, joking, of course. Thank you very much for coming to the Flow Show this week. I believe the K-Meister will be back next week, as probably will Stelios be if he's not buried up to his eyeballs in sand by his kids. So back to full steam, potentially from Monday. A big week, big central bank week, obviously, so lots to keep us entertained. Thank you very much. Have a great weekend. Have a great rest of your day. Good trading to you all. See you all on Monday. Have a great weekend.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.